Welcome to Sales Accelerators, Winning Strategies for Financial Professionals, an educational webinar series that explores the latest tools and concepts to help boost your sales performance and drive business growth. Join us as we analyze trending topics in life insurance, investigate the latest headlines, and discuss solutions to accommodate your clients' unique needs. Please welcome your host, Kurt Fasen, Executive Vice President of Sales and Marketing.
Well, hello. Welcome to another edition of our webinar series, Sales Accelerators. My name is Kurt Fasen, Executive Vice President here at TBS, and this is our webinar and podcast that helps you to increase your sales and truly improve your business. Today, I'm pleased to have Scott Safranek with us, Managing Director at MassMutual Strategic Distributors. He has decades of experience and brings a true worldview to help us understand the insights and the intricacies of today's topic. Scott, welcome.
Kurt, thank you. Thanks for having me. I look forward to the conversation.
Absolutely. It's good to see you again, and I'm excited to get into our topic. But before we get going, those of you that have been with us before, you know what I'm going to say. Pull out your webinar action sheet. That's something you got when you registered. All right, so if you lost it, just find a yellow pad and start writing down those clients, those prospects, the people that come into your mind as Scott and I are having our conversation. The way you truly put these into motion is by taking action on what you learned today. All right, let's jump into it. We're hearing from advisors, Scott, that their clients are really feeling reluctant to take action. We've had a lot of uncertain times. And it sounds like your team, your advanced markets team at MassMutual, has been providing a bit of commentary on this topic. And I'd like to hear from you, what is their take on the market volatility?
Sure. Yeah. So our advanced markets view is that the client's hesitation is understandable. But what we're seeing is market rotation and repricing, not a breakdown. Early 2026 has brought us geopolitical tension, higher commodity prices, shifting Fed expectations, and a pullback in expensive growth in AI stocks. Now, that's made investors a little more sensitive to rates, earnings visibility, and risk. Now, beneath the surface, money has rotated out of technology and consumer names and into more defensive cash flow oriented areas like energy, materials, and utilities. Importantly, though, markets have responded in a measured way. Equities were only modestly negative, and treasury yields, while higher, remain with recent ranges, suggesting investors are pricing uncertainty while still expecting stabilization. Now, the takeaway for investors or advisors is that this is a shift from liquidity-driven returns to a more selective, risk-aware environment. In periods like this, diversification matters more than timing. For example, a portfolio that combines growth assets like equities, defensive assets, bonds or alternatives, and non-correlated strategies such as permanent life insurance with guaranteed cash value can really help smooth volatility while keeping a long-term plan on track. In short, Kurt, uncertainty doesn't mean stop. It means be intentional.
Scott, that's definitely true. And generally speaking, I think we're talking about reasonably, we're in a good place, right? You know, fairly stable despite some market challenges. And we're going to see some downturns, right? Economic uncertainty, what's happening currently in the world. But Scott, what's the upside on this? In other words, what do you want to tell advisors to do?
Great question, Kurt. Thank you for that. The big picture, despite ongoing economic and global uncertainty, we're still in a reasonably stable place. Short-term downturns may happen, but history shows they are normal. They're a normal part of a long-term market growth. Since 1926, the market has experienced only 4 periods where returns were negative for 2 or more consecutive years. And yet, the long-term compound annual return has still been 10% plus. So more importantly, though, every one of these downturns has followed by periods of above average growth.
Right.
So the upside for advisors to focus on, really, down markets are not the enemy. They're often the setup. Volatility creates opportunity for disciplined investors who stay well diversified and committed to a long-term plan. So what advisors can tell their clients to do? Maybe three things. Stay invested, stick with diversification, focus on long-term goals and not headlines. And breaking those down individually, stay invested. The data consistently shows it's time in the market, not timing the market, that drives long-term success. Number two, stick with diversification. A well-balanced portfolio can help weather short-term declines while positioning clients for the eventual rebound. And number three, focus on long-term goals, not headlines. Temporary uncertainty doesn't derail long-term planning unless emotions take over. In short, Kurt, uncertainty doesn't eliminate opportunity. It reinforces the value of patience, diversification, staying committed to a long-term strategy. Markets will keep making noise. Our job is to stick to the plan, kind of especially when my crystal ball continues to be wildly unreliable.
Yours and mine. I'm glad you have one. I can't even find a crystal ball. I love the way you laid that out, and it intuitively makes a lot of sense. But Scott, you and I are both in life insurance business. How can this help on the life insurance side of the equation?
You bet. And that's it's always fun that we're talking about life insurance. We happen to be in the life insurance business, and we're presenting the dragon, and I've got the sword to slay the dragon. So the bottom line is we can't predict markets, but we can prepare for them. That's kind of the bottom line there. Market volatility is unavoidable. What is controllable, though, is how flexible a client's plan is when volatility shows up. One way to add that flexibility is by incorporating assets that aren't directly tied to market performance. That's where whole life insurance can complement, and I say complement, a traditional portfolio. So in addition, Kurt, to providing a guaranteed death benefit, whole life insurance builds cash value that grows contractually over time and does not decline due to market conditions. The cash value accumulates tax deferred and can be accessed in a tax-advantaged, tax-free manner if set up properly, creating an alternate source of liquidity. But so why does this matter in practice? Now imagine a client with a stock-heavy portfolio entering retirement during a market downturn. Instead of selling equities at a depressed value to generate income, the client can draw from a whole life policy the cash values inside of a whole life contract, giving the portfolio time to recover and helping reduce sequence of return risk. I mean, the bottom line, in short, whole life doesn't replace growth assets. It complements them. Complements them by adding stability, diversification, and control, especially when markets are unpredictable.
I love the complements comment and the fact that it provides stability. I mean, how many times have we over the years, for those of us that have been doing this for a while, Scott, over the years, you watch the markets and they seem to be just wild. And you think about the individual that all of you are working with in the marketplace right now that are reaching the retirement years, and to have something help stabilize it, that's the payday. That's the payday for them. It allows them to do this one thing that I think we all want to do in retirement, and that is to sleep well at night.
Yes.
Right?
Yes.
So maybe you could go into a little bit more detail. Can you explain this concept payoff more or less?
Sure, absolutely. Be happy to. So, this is kind of where the concept really starts to matter.
Yeah.
When you're saving for retirement, market ups and downs really are just noise. You're adding money over time, so the order of returns doesn't have much impact. What matters most in the long is what matters the most is long-term average return. But once you retire and start taking withdrawals, the order of returns, what we call sequence of return risk, becomes extremely critical. Now, here's a simple way to think about it. Excuse me. Imagine two retirees who each start with $1 million and experience the same average return over 25 years. The only difference is when the bad returns happen. One gets negative returns early in retirement, and the other gets them later. Even though the long-term returns are identical, the retiree who experiences losses early while taking withdrawals can see their portfolio depleted much faster and even run out of money. Now, that's because withdrawals during down markets permanently reduce the portfolio's ability to recover. That's how this concept can pay off. By having assets or income sources that aren't tied to market performance, retirees can avoid selling investments at the worst possible time, and it gives their portfolio breathing room to recover. In short, accumulation of assets, averages matter. In retirement, decumulation of assets, timing matters. Managing sequence of returns isn't about predicting markets. It's about building flexibility so clients do not have to make irreversible decisions when markets are down.
That makes sense as well, but I'm going to push you a little bit further, Scott. I think it'd be helpful for our audience for you to just dig a little bit deeper. Talk more about how life insurance can really help.
Absolutely, Kurt. Great question. Now, the real risk shows up in the decumulation phase, when clients stop saving and start taking withdrawals. While market ups and downs really don't matter much during accumulation, they matter a whole lot in retirement. Taking withdrawals during market downturns, those can permanently damage a portfolio. And that's, again, what we call sequence of return risk. Now, breaking it down, for example, a hypothetical $1 million portfolio withdrawing 65 grand a year can last up to 25 years under one return sequence, but run out of money early in another, even if the average returns are the same. The difference is simply when negative returns occur. Now, this is where planning can really pay off. Instead of selling investments at depressed values during a downturn, clients can use tax-advantaged distributions from an existing whole life policy, which isn't tied to the market. And that gives the investment portfolio time to recover. And the biggest takeaway, I believe, is, again, we can't predict markets, unless my crystal ball can, but we can prepare for them. A whole life policy adds a conservative, non-correlated element to an overall accumulation strategy, providing liquidity, tax efficiency, and flexibility when it matters most, especially in retirement.
You know, the non-correlated asset aspect of what you're talking about, Scott, I think is the key, right? As the whole portfolio starts moving right or left, the whole life is non-correlated, and that just stays very, very steady. Maybe we could look at an example. For me, it's easier if I can see numbers. Can you put some numbers to this for us?
I agree wholeheartedly there, Kurt. Now listen, so as you'll see on the screen, the big picture. What are we testing here? As an example, let's take a $5 million retirement portfolio. Retirement starts at age 65. We're taking $250,000 a year of income for 20 years. And the comparison here is 1 without life insurance and 2 with whole life insurance. Without life insurance, all income comes from the portfolio. With whole life insurance, we're showing $1 million of income that comes from the insurance side and $4 million from the portfolio. The takeaway on that is using life insurance as a supplemental income source reduces stress on the investment portfolio. Now, going down further, looking at the next image is sequence of return risk, order versus reverse order. So the critical concept really here is the average return is the same, but the order of returns is different. In scenario 1, negative markets early in retirement. Scenario 2, negative markets later in retirement. Now, why does this matter? If you withdraw from a portfolio during early down markets, the damage compounds and the portfolio may never recover. The result there, sequence of returns, not average return. That is often what determines whether money lasts. Again, sequence of returns, not average return, is often what determines whether money lasts. And if we look further, Kurt, how insurance changes the outcome, taking a look at the images that you see on your screen there. What changes when life insurance is added? During market downturns, income is taken from policy cash value, not the portfolio. Portfolio assets are left untouched during losses. And what is our outcome? Our outcome is the portfolio has time to recover. Ending portfolio values are significantly higher. And as you'll see on your screen, that's labeled as portfolio protection from insurance. And looking at the combined effect, these pages combine remaining portfolio value, policy cash value, policy death benefit. The key insight here, folks, is when you look at total household balance sheet value, the strategy using life insurance ends with materially higher combined wealth, regardless of market order. And looking at again, sticking on the visual summary here, the simple chart shows portfolio plus cash value over time and portfolio plus death benefit over time. The consistent result, the insurance supported strategy produces smoother outcomes and higher ending values, especially in bear markets. And what I take away and what you should take away from this is, again, and this is kind of a common theme, I think, we can't predict market downturns, but we can plan for them. A sequence of returns is one of the biggest risks or biggest threats in retirement. Whole life insurance, adding it to a portfolio, provides liquidity not tied to markets, uncorrelated asset or non-correlated asset, tax advantage income flexibility, and a buffer. It's a buffer strategy that protects long-term assets.
That was amazing. Thank you for walking us through that. And it really drives home. This is a great conversation to have with clients, especially in today's economic environment. And I say that, but there's always something in the economic environment. So I don't know that there's ever a wrong time to have this discussion. But I think one thing that you've threaded in here is the conversation you brought into the conversation whole life. So let's take a moment. Maybe you can take a moment because in the room you're the expert. So let's walk through, reiterate the benefits, Scott, of whole life insurance in retirement.
Yeah, no, great question, Kurt, and I appreciate the question. Now think about it. The key benefit of whole life insurance in retirement is stability. MassMutual's whole life insurance is not tied to market performance. It does not decline in value due to market conditions. It's guaranteed to go up every single year. The only question is by how much. With 158 consecutive years of paying a dividend, to me, that really says stability. And during the working years, a whole life policy provides life insurance protections family needs. Over time, it builds cash value that can serve as a financial cushion in retirement, especially during market downturns. Unlike market-linked investment assets or other permanent life products, whole life is not exposed to market volatility. That means when markets are down, the policy's cash value is still there, unchanged, helping to smooth retirement income and reduce pressure on investment portfolios. In addition, Kurt, distributions can be structured in a tax-advantaged way. Clients can access their cash value inside of a whole life contract to the amount of premiums paid, and then use tax-favored policy loans if additional income is needed. So what's the bottom line? The bottom line is whole life just, it adds a conservative, predictable element to a retirement strategy. providing protection, liquidity, and flexibility when markets are uncertain and when retirees need it most.
That's great. I mean, hopefully, you can see this. Hopefully, you guys have all filled out your yellow pad now, because there must be a lot of clients that you know that helping to explain the risk of sequencing of returns, how important that is, how important that's going to be to their retirement, and how something as simple and easy as whole life can really make a difference. I want to remind you of a couple things. Don't forget, I'm going to put up on the screen right now, and for those of you that are listening in the car, just assume there's a screen going up, but we have a whole team of regional sales directors. They're ready to help you to really take it to the next step, whether it's talking about more specific situations that you have, or you can also lean on our case design analysts. Our case design analysts as well are there ready to help run illustrations and kind of show you how this really works. But if you don't know where to start, go out to our DBS website. We have a number of client worksheets that can really just help facilitate the conversation and help it to get going. Overall, Team DBS is here to help you, from our advanced markets team to our in-house underwriters. Whatever you need, we're here to help. Scott, thanks so much for joining today. Wonder if you have any final words for our audience.
Well, sure. First, Kurt, I'd just like to thank you and the entire DBS team for being there. And 30 years I've worked with you all, more than 30 years, and there's nobody better out there. You guys are a terrific group of people. But I'll close with this. And the study we looked at here today, it shows that whole life insurance isn't meant to replace investments. It's meant to support them. Again, I can't stress this enough. Whole life insurance isn't meant to replace investments. It is meant to support them and complement them. And it does that by adding a conservative, non-correlated asset to an accumulation strategy. Clients gain flexibility in retirement, reduce sequence of return risk, and improve their odds that their wealth lasts, especially when markets misbehave early. Or simply put, markets are unpredictable. A plan built in flexibility is not.
Fantastic. Scott, thanks again. And thank you, everyone, for taking time out of your schedule to join us for another edition of Sales Accelerators. We look forward to seeing you again here real soon. Until then, be well, stay safe, and take care, everybody.